Who is required to or should file the U.S. individual tax return, the tax form 1040? If you are a U.S. citizen or resident alien, your obligation to file a federal income tax return depends on several factors: your filing status, your age, your gross income, and whether you are claimed as a dependent. These rules apply to all U.S. citizens, regardless of where they live, as the U.S. tax system is based on worldwide income. Even if you are not required to file, there are situations where you should file anyway. You can find filing requirements on the IRS website and in the instructions for Form 1040, as well as in IRS publications 501 and 17, which cover the same information. For most taxpayers, filing is required if your gross income exceeds the thresholds based on your filing status and age. For example, if you are filing as single under 65 and your gross income is below $14,600 for 2024, you are not required to file. The taxpayers who typically fall under this chart are those whose income mainly comes from wages reported on W-2s. If you are filing as married filing jointly and both spouses are over 65, you are not required to file if your gross income is below $32,300. However, if you are filing as married filing separately, you are generally required to file regardless of your income. What is considered gross income though? Gross income includes all taxable income you receive in the form of money, goods, property, or services. This covers wages, salaries, pensions, interest, dividends, rental income, tips, capital gains, and income from sources outside the U.S. It also includes gains from selling your main home, even if some of it or all of it is excluded from taxation. What about capital gains and losses? How do you treat them? Capital gains are included in gross income, while capital losses are not. Meaning, gains must be reported on Form 8949 on Schedule D and are factored into your filing requirement. However, if you have stock losses, you cannot simply subtract them from your gross income to determine whether you need to file. Only stock gains count when testing your filing requirement. What about income from businesses or farms? Similarly, for business income, gross income includes the amounts reported on Schedule C, Line 7, or Schedule F, Line 9. When calculating gross income for filing requirement, you do not subtract business or farm losses. Only profits are included. What about Social Security? Do you need to include Social Security benefits in your gross income? It depends on your situation. Don't include any Social Security benefits unless A. You married filing a separate return and you lived with your spouse at any time during 2024, or B. 1/2 of your Social Security benefits plus your other gross income and any tax-exempt interest is more than $25,000 for single, head of household, or qualifying surviving spouse, or more than $32,000 for married filing jointly. For example, if you're single, over 65, and receive only Social Security income of $20,000, do you need to file? No, because first, you're not filing married filing separately, and half of your Social Security, which is $10,000, is below the $25,000 threshold for determining taxable benefits. In this case, your gross income is effectively zero, which is well below the $16,550 filing requirement for single over 65. You wouldn't be required to file, but there may still be good reasons to do so, which we will cover later. The first step in determining if you need to file with Social Security income is checking whether you meet the filing requirement. The next question senior taxpayer asks is how much of my Social Security is taxable. Depending on your total income, your Social Security benefits may be completely tax-free or taxed at 50 to 85%. As shown in this table, using the combined income formula, if your total income falls below the lower base, none of your Social Security is taxable. If it falls between the lower and upper base, up to 50% may be taxed. And if it exceeds the upper base, up to 85% of your benefits could be taxable. Here's an example. You're single, over 65, and earn $25,000 in wages. You also receive $20,000 in Social Security benefits. To determine how much of your Social Security is taxable, take half of your benefits, which is $10,000, and add it to your wages of $25,000, giving you a total of $35,000. Since this amount is above the $34,000 upper threshold, up to 85% of your Social Security benefits may be taxable. What if you are a dependent? Are you required to file taxes? For most taxpayers, filing requirements are based on gross income. But if you are a dependent, different rules apply, as shown in this table. For example, for a single dependent under 65, in 2024, they are required to file if any of the following are true. First, their unearned income, such as interest, dividends, or capital gains, exceed $1,300, or their earned income, such as wages or salary, exceed $14,600, or a third one, their total gross income, meaning earned plus unearned, exceeds their earned income plus $450. Let's go to an example. A dependent has $6,000 in earned income from wages and $1,000 in unearned income from interest, making their total gross income $7,000. To determine if they have a filing requirement, we take their earned wages of $6,000, add $450, which equals $6,450. Since this amount is less than their gross income of $7,000, they are required to file. The $1,000 in interest income pushes them over the filing threshold. Now, if this dependent only had wages of $7,000 on a W-2, they wouldn't be required to file. However, because of the unearned income like interest is treated differently, they must file a tax return. Most dependents, though, are not required to file. However, even if not required, many dependents should file to claim a refund if they had any withholdings. The requirements in Table 1 and 2 are general filing requirements that apply to most taxpayers. However, there are additional situations where you may be required to file a tax return even if you don't have a high gross income. They are listed in Table 3. The first one, if you earn $400 or more in net income from self-employment, such as side job or gig work, you generally must file a tax return. This is true for everyone, including dependent taxpayers. Net earnings are calculated by subtracting your ordinary and necessary business expenses from the total income you earned from your self-employment activities. For example, if you made $1,000 from a gig job and had $300 in expenses, your net income would be $700 and would trigger a filing requirement. On the other hand, if you had $1,000 in W-2 wages, you would not be required to file. The reason for this is that no Social Security or Medicare taxes are withheld from self-employment income. so the taxpayer must file taxes to pay them. Another reason you may be required to file is if you owe any special taxes. These are typically reported on Schedule 2 of Form 1040 and can include taxes on IRAs or health savings account, taxes on household employees, alternative minimum tax, Social Security or Medicare taxes on unreported tips, or recaptured taxes. Another reason you may be required to file is if you or your spouse have any distributions from an Archer MSA or Health Savings Account HSA. You must file and report how the funds were used, ensuring they were spent on qualified expenses to avoid taxes. Another lesser-known reason to file your taxes is if you received advance payments of the premium tax credit on Form 1095-A. What does this mean? This means the federal government helped cover your medical insurance premiums throughout the year with subsidies. These subsidies were based on your estimated income, so when you file your taxes, you will need to reconcile whether you received the correct amount, too much, or too little. Finally, if you earned more than $108.28 from a church or church organization, you're also required to file. So specific. What about if a taxpayer dies? You must file a tax return for a deceased person if both of the following are true. 1. You are the surviving spouse or the executor, administrator, or legal representative, and the deceased would have been required to file if they were alive, according to the previously mentioned reasons. You would have to write deceased, the descendant's name, and the date of the death at the top of the return. For more details, see Publication 559. We have covered situations where you are required to file, but what about reasons to file taxes even if you are not required? The main reason to file your taxes is to claim any withheld income taxes your employer deducted from your paycheck throughout the year. That's why a lot of dependents file, even when they don't have to. How long do you have to claim your refund? If you were owed a refund but didn't file, you typically have 3 years from the original due date, including extensions, to file and claim it. After that, the U.S. Treasury keeps the money. So for tax season 2024, you can still claim refunds for 2023, 2022, and 2021. Especially if you didn't file your 2021 tax return, you could miss out on a $1,400 stimulus payment that U.S. taxpayers received from the government during pandemic. You have until April 15, 2025 to file and claim it. So don't wait. The fastest way to get your refund is through direct deposit. You should expect to receive it within 3 to 4 weeks. You can also check your refund status at irs.gov/refunds. Another reason to file is if you made estimated tax payments or applied last year's refund to this year's estimated tax, but ended up not earning enough to file. You will need to file your taxes to get those payments refunded to you. Another important reason why taxpayers should file their taxes, even if not required, is to claim refundable credits. While most tax credits reduce the tax you owe, refundable credits can actually provide a refund beyond what you owe, including the Earned Income Tax Credit, which offers up to $7,830 for eligible low to moderate income workers for 2024, the Additional Child Tax Credit, which provides up to $1,700 per child in possible refunds in 2024. Full-time students may also qualify for the American Opportunity Credit with up to $1,000 in refundable amount. Additionally, if you had marketplace health insurance and didn't receive enough in subsidies, the premium tax credit could result in a refund. And businesses using fuel for exempt purposes may also qualify for the fuel tax credit. Filing your taxes, even if you didn't owe taxes or were required to file, can ensure you receive these refundable and partially refundable credits. Another reason to consider filing taxes is if you received Form 1099-B from your broker and meet these two conditions. First, adding the amount in Box 1D to your other income pushes you over the filing threshold, and the Box 1E is left blank, meaning there's no cost basis reported for the sold security, and so you are taxed on the entire amount of proceeds. While filing may not be required, doing so could help you avoid an IRS notice down the line. What about if you need to figure this out if you need to file? If all this information feels overwhelming, the IRS Interactive Tax Assistant can help you. By answering a few questions, you can determine whether you're required to file a federal tax return or if filing could benefit you, such as receiving a refund. Another reason to file your taxes is to avoid having the IRS file a substitute for return, SFR, on your behalf, based on third-party information. For example, if your circumstances change, such as having a new dependent, the IRS may not be aware of it. They could assume you're required to file. If they believe you should have filed but didn't, they will create an SFR for you. However, the IRS will include all income but may not apply any credits or deductions you're entitled to. To ensure your filing is accurate and to claim all eligible credits and deductions, it's best to file your own return. Additionally, there are few reasons to file your taxes which may not be directly related to your income tax. For self-employed individuals, accurately reporting income on your tax return is crucial because it helps calculate your Social Security benefits. Failure to report income can result in incorrect benefit calculations in the future. Second reason, when applying for financial aid, students may need to provide tax information from their own and their parents' tax return. The IRS data retrieval tool allows applicants to securely transfer data directly from their tax return to the FAFSA form, simplifying the process. Filing your taxes on time can also help protect your identity from theft. It prevents fraudulent tax returns from being filed using your information. It detects identity theft faster when you file regularly, and it facilitates faster resolution if there is an issue. In case you feel personal information may have been compromised, you can also request IRS PIN to verify your identity when filing. Finally, many states offer senior freeze programs, which provide lower real estate taxes for low-income seniors. Tax returns are often used to verify income for eligibility. Similarly, when applying for Medicaid, a health insurance program for low-income individuals, tax returns are primary source of income verification. Finally, while not always required, tax returns can play a significant role in securing loans, as lenders often use them to assess your financial stability. Just because you're not required to file a federal tax return doesn't mean you can skip your state taxes. Federal and state tax systems are separate, and each state has its own filing requirements. In some cases, the income threshold for the state taxes may be lower than the federal one. For example, if you're over 65, receive $20,000 in Social Security income, and make $10,000 in capital gains, you wouldn't need to file a federal return. However, in Illinois, your $10,000 in capital gains would trigger a state tax. because the state exemption is lower than the federal standard deduction, making most of your capital gains taxable even if none of your Social Security income is. When do you have to file your tax returns? You must file Form 1040 or 1040-SR by April 15, 2025. If you file after this date, you may face interest and penalties. Do you need more time? You can request a 6-month extension by filing Form 4868 no later, though, than the original due date of your return. However, be aware that even when you request the extension, this only gives you more time to file. It does not extend the time to pay your taxes. If you don't pay by the original deadline, you will owe interest on the unpaid amount and may incur additional penalties. If you decide or are required after all to file U.S. income tax return, what are your options? You can prepare your tax return yourself, qualify for free tax preparation, or hire a tax professional to help. A new filing through the IRS Direct File option is available in 25 states for 2024. It is designed for taxpayers with simple returns. While it doesn't prepare state returns, it guides you to state-supported tools, whatever that means. Another IRS-approved free option is the IRS Free File. For 2024, 8 tax software companies are participating in the program, offering free filing for those who qualify. Some require your adjusted gross income to be below $84,000, while others cap it at $48,000. Be aware that not all companies offer free state returns, and there may be other eligibility criteria. To use these programs, make sure to start your tax return directly from the IRS website, not the software provider's side, as the free filing options can differ. For example, TaxSlayer's free file allows you to file with dependents, while the free version on tax software website may not. If you are in the military or a veteran, you may qualify for a free in-person tax preparation through the Mill Tax program, which has no income limits. Additionally, you can access free tax preparation through VITA and TCE programs, which are managed by the IRS and staffed by volunteers. VITA is available for individuals earning less than $67,000 annually, while TCE focuses on seniors and is run by AARP. You can find local sites using the IRS locator tool. Once you specify your zip code, you can see the providers of the free tax preparation, distance from your location, when it provides its volunteering services, and whether an appointment is required. If you prefer a paid preparer, you can use the IRS directory of federal tax return preparers to find a professional with credentials such as CPE, EA, or a law degree. What happens if you are required to file but don't? There are 2 main penalties you could face: failure to file penalty and failure to pay penalty. The key thing to remember is that failing to file usually costs you more than failing to pay. If you file your return late, the penalty is typically 5% of the tax you owe for each month or partial month your return is late. The penalty can go up to 25% of your unpaid taxes. For example, if you owe IRS $1,000 and don't file, the penalty for not filing would be 5% of $1,000, which is $50, each month, up to $250. On top of that, if the return is filed more than 60 days later, the minimum penalty is the amount listed in this table. On the other hand, if you fail to pay taxes owed on your return, the penalty is 0.5% of the unpaid amount for each month or partial month until paid, capping at 25% of the total owed. For example, if you owe the $1,000 and don't pay, the penalty would be 0.5% or $5 per month, up to maximum of $250. So you can see it's much less than the failure to file. If you fail to both file and pay, the combined penalty rate is capped at 5%. In addition to penalties, the IRS charges interest on unpaid taxes. Interest starts with the federal short-term rate plus 3%. To avoid penalties and interest, it's important to file your tax return in the first place. Consider using free tax preparation software or services. If you do file but you can't afford to pay all your tax due, consider applying for the IRS installation plan. Thanks so much for watching and good luck!